what's your prediction on tomorrow's CPI number, and what implication would that have for TLT?
Just lower. So lower in rate of change terms. It's really hard to surgically predict the number to like the very decimal point, but lower than where it was at its peak.
Yeah, definitely. We were going over this last night with the client. There's a number of ways you can sort of predict monthly data points, and most of them are wildly inaccurate. But in terms of getting the directional trend right, they can be somewhat confirming based on what you already know about the base effects, et cetera, et cetera. So based on 1 to 3 month momentum, you could see CPI decelerate to anywhere in between 2.6 and 2.8%, which obviously is lower, as you just said, than 2.9%. So obviously bond yields are responding this morning lower to this morning's PPI report, and we would expect that to continue into tomorrow's CPI report as well.
So one thing, so anytime you have a data point, here's a teaching point. And thanks to Jack Karpinski for asking the other day, as a young investor, what would you do? And my answer to the question was, check all the establishment's views, ideologies, and opinions on what should happen at the door, and focus on measuring and mapping the data yourself. Writing it down every day, Jack, for 20 years. Eventually, it started to sink in that if I know where these data points are, so if I'm looking at CPI or headline inflation, which is the #1 predictor for long-term bond yields, I want to know where that July data point is relative to where the next data points are going to be. So again, next 2 data points, we think they're going to look like that. You could also have, which actually the model is suggesting currently, you can get that, and then you get another lift, and then you lift higher, and then down again. But this topping process is what's going to be going on here in the 3rd and the 4th quarter. All right, so that's important. Always when you ask yourself an economic question, where's the dot? Where's the latest data point on that sine curve? If it is accelerating at a lesser rate, or if it's past its peak, we're on the backside of that risk, or start the beginning of the risk, rather. If it is accelerating from like something like this, which inflation is, for example, in Brazil off a 2-year low, then the inflation component for them is going that way. So that's a really bad thing for Brazil. It's a really bad thing for Argentina, a really bad thing for Peru, Chile, etc. Again, it's nothing against these economies. It's just what the #1 factor of risk is starting to do, and it's not doing a good thing.
Yeah, no, and I also, before we move on to the next question, I do want to clarify, that's the scenario you just outlined with the secondary peak is not the baseline projection for the model. That's the projection if you isolate the 3-month average sequential momentum across the base effects. If you isolate the 1 month or the 2 month sequential momentum, it's piking down.
Yeah.
It's so like there's a wider range of outcomes if you start to look at it on a monthly basis. But on a quarterly average basis, inflation is the highest probability outcome is that inflation trends lower in each successive quarter.
The two things that we try to focus you on, hopefully we're clear on this, or these two dots right here. That this was the peak. We were long inflation, don't forget, going all the way back. So quad 2, again, we want to be long inflation, energy, commodities. You can go back, check it, and stay with that. But today is a really good example of what you expected today and what we expected. If I didn't expect inflation to go down sequentially in the producer price index, then I would have been long energy, commodities, inflation hedges, etc. I would have been chasing the short side of bonds. But I did not. So what we expected today was different than what Wall Street expected. This is really and quintessentially why we're so competitive about it, but also why we want you to understand why you're making money on it. So again, we have explicit views with explicit timing and catalysts, and today's a great example of what we expected coming to fruition versus Wall Street's expectations. What they'll say today, unexpectedly, inflation fell.